Welcome to The Explainer. Our job is to take really complex subjects and boil them down into simple visual explainers so you can get the big picture fast.
So, what if a company's best strategic move was to just swallow its rival whole? Or maybe to defend itself with something called a poison pill? Sounds dramatic, right? Well, today we're diving into the high-stakes world of corporate restructuring. Think of it as a strategic battlefield where companies are constantly fighting to grow, survive, and dominate.
At its core, corporate restructuring is basically a company's master playbook for staying competitive. And it's not some one-and-done deal. Nope. It's a continuous process of adapting to the market. And it covers everything from massive, aggressive expansion to, believe it or not, strategically shrinking down.
So, let's start with the attack, the exciting part. These are the strategies companies use to expand their empires and conquer new territory.
The most direct way for a company to grow is through mergers and acquisitions, which you've probably heard called M&A. This is when two companies decide to become one. And most of the time, this is all pretty friendly. Management teams get together, they negotiate, and they agree that they're just stronger together. But what happens when the leaders of the target companies say no thanks? Well, the acquirer can actually go right over their heads with something called a tender offer. This is a direct appeal to the company's real owners, the shareholders, offering to buy their stock at a premium, a price that's way above what it's currently trading for.
And if enough of those shareholders accept the offer, even though their own management is against it, boom, you've got a hostile takeover. This is where the battle really heats up, and it forces the target company to pull out its defensive playbook.
So how exactly does a company defend itself from a buyer it doesn't want? Well, it has a whole arsenal of defensive tricks designed to make itself a much less appealing target. The first line of defense is often what's called the golden parachute. This basically guarantees top executives a massive payout if they lose their jobs in a takeover. The idea here is to make the acquisition so expensive that the buyer just backs off. But as you can imagine, this one's pretty controversial because it can definitely look like managers are just looking out for themselves.
And this tactic can be seriously abused. Our source material points to the case of optional ventures, where executives use this exact clause to walk away with millions. It wasn't really a defense at all. It was a way to, and I'm quoting here, legally extract company funds. Yeah, that raises some huge ethical red flags.
Then you've got the classic poison pill. This strategy is designed to make the company, toxic to the acquirer. A really common way this works is the target company allows all its existing shareholders, everyone except the hostile bidder, to buy up a bunch of new shares at a huge discount. This floods the market with stock, waters down the acquirer's stake, and makes the takeover just ridiculously expensive. And sometimes, the simplest defense is to just pay the attacker to go away. This is called green mail. The target company literally buys back the stock the acquirer has been buying up, but pays a premium for it. It's basically a multi-million-dollar bribe just to be left alone. Companies can also get creative and rewrite their own internal rules. They might add a supermajority rule that requires, say, 90% of shareholders to approve a merger, which is almost impossible to get. Or they can stagger the terms of their board members, so it would take an acquirer years to gain control of the board even after they've bought the company. But offense and defense aren't the only moves. Sometimes, the smartest play in this big corporate game of chess isn't to get bigger, but to actually get smaller and more focused. A company can shrink in a few ways. In a spin-off, a whole division becomes a new, independent public company, and shareholders get stock in both the original and the new one. A split-off is more like a trade. Shareholders can choose to swap their parent company stock for shares in the new subsidiary. And then there's the split up, which is the most drastic of all. The parent company is completely dissolved and broken up into several new, smaller firms.
The most straightforward way to shrink, though, is a divestiture. This is simply selling off a part of the business, like a division or some assets, to another company. The goal here is usually to raise cash and really sharpen the company's focus on its core, most profitable business.
So, after all these intense battles, the takeovers, the defenses, the strategic retreats, who actually wins financially? Well, the data from our source material tells a pretty surprising story. In a hostile tender offer, the shareholders of the company that's being acquired get a massive reward. On average, their stock value can shoot up by as much as 35%. And here is the crucial point. Look at the huge imbalance in who profits. While the shareholders of the target company often win big, the shareholders of the acquiring company The ones who are supposedly winning the battle usually see only a tiny bump in their stock price, if they see one at all.
And this chart reveals a much broader trend. When you look across all these different types of restructuring, the pattern holds true. In mergers, tender offers, even huge buyouts, the financial benefits are almost always skewed heavily toward the shareholders of the company being sold or restructured, not the one doing the buying.
And all of this brings us to our final big question. If the data clearly shows that it's often way more profitable to be acquired than to do the acquiring, why do so many companies fight so hard to get bigger? It makes you wonder. In the corporate art of war, is the ultimate victory really found in the attack, the defense, or in knowing exactly when it's time to retreat?